by our President and CEO, Dr. Richard Michaud, and Research Analyst Vitaly Ryabinin. So today's webinar is going to kick off with an overview of our investment philosophy and process, followed by a look at how our portfolios and the market overall has performed in the past quarter. Then we'll move into a discussion of Dr. Michaud's market perspectives, and we'll open the floor up for some questions from the audience. And then finally, we'll wrap up with a few updates from the marketing team. Just a quick housekeeping note before we begin. Your lines will be muted for the duration of the call to reduce background noise. So if you have any questions, please submit those to us using the chat feature of GoToWebinar. And without further ado, I will pass things over to Dr. Michaud.
Good afternoon, everybody. Thank you for coming. Thank you for being with us. So my role here is to talk a little bit about our philosophy and process. And so some of you may have heard this before, so I'll try to be very brief. However, I think for those who may not have heard it, it's probably a good thing to do. Anyway, we are an institutional research and investment advisory firm. We are global software providers with multi-patented software. We are an institutional quantitative manager has been managing ETFs, multi-asset ETF portfolios for 13 years. Recently, we just launched a global balanced ETF index, and we'll talk a little bit about that. We are inventors and authors in investment technology. The original book was published by Harvard and the second edition by Oxford. And we have a number of journal articles, manuscripts, and academic and professional presentations. You can find many of them on ResearchGate and SSRN. We are an institutional, global, multi-asset, ETF, active, optimized manager. Each word in that little point is pretty important. We are strategic, not static. We are an active manager, but not rules-based at all. We focus on risk management. We are compound return efficient because we are focused on long-term investing. Globally diversified because that is the best way to think about investing long-term. State-of-the-art technology and research. We are unique in our optimizer, our rebalancing, and we are an independent ETF manager. So this is how we think about our strategies. We have a strategic, optimized, risk-targeted portfolios that at the bottom of the efficient frontier, we have 20% equities, and in steps of 20, 40, 60, 75, 90, and 100% equities. And so these are the strategic, risk-targeted portfolios that are part of our process. We have a unified investment process. We begin with something in the order of sometimes 40 ETFs that we pay attention to, and we end up with roughly 25 in our strategies. We are strategically estimating risk and return. We have the optimizer and the Michaud optimizer and the rebalancing process. We end up with 3 different kinds, flavors, if you wish, of our strategies: total return, after-tax optimization, and income sinking. And we just finished talking about the 6 profiles for 2 of the strategies and 3 for the other. So the New Frontier strategic process is a traditional one in some sense. We have to find asset classes that we care about. We use exchange-traded funds, low-cost, high-quality funds. And we have to make that process is actually very intensive in Frontier. And then we have risk return estimation, economic theory. We use current information. We use statistical methods. We're not forecasting the future. We use information in the best possible way in terms of what's happening now. And then we have the Michaud optimizer and the Michaud-Hedge rebalancing test. We'll talk a little bit about that in just a minute. So here is a kind of stylized spectrum of ETFs. We have 25 actually, roughly in every one of our strategies. But we have equity domestic and equity international, global asset manager that we are. We are fixed income, government, and corporates. and we have others, including real estate and gold. What's important about this slide is the care that we go through to try to capture really well-behaved, low-risk, very high-quality, low-cost ETFs, and that fit in properly with global investing. Long-term investing principles, one of the highlights and one of the keys for our strategies. Long-term investing is different. There's a couple papers that you might find interesting. For example, if you have a game where you double your money half the time and halve your money half the time, that's a 25% average return. But if you think hard about how to play this game for any period of time, what will happen is half the time you will double your money, half the time you'll halve your money, and you'll end up with a zero return over time. So a diversified, lower risk strategy may outperform over time. And the actual key is effective diversification for long-term investing. Global investing is another key in how we think about what we do. We span the global investable of economic value, just more opportunities to add value. Optimization is sometimes thought about fairly simplistically. You have a bond portfolio, you have a stock portfolio, and then you have some kind of allocation to the stock portfolio, like 60% to that one portfolio and 40% to a bond portfolio. This is how many organizations actually manage asset allocations. Optimization has a lot of potential to add value, more return for the same level of risk or less risk for the same level of return. It is also more natural investing because the top of the curve has more risky assets and the bottom of the curve has less risky assets. Well, unfortunately, in a paper that I wrote that a number of people have read, the optimizers are very unstable. A small change in the inputs can lead to very, very large changes in the optimized solution. Very poor diversification can result. Hard to manage portfolios can result. Poor performance, bottom line, of course, can result as well. So to give an example of this, I have 10 asset classes: money market, intermediate fixed, small cap growth, large cap value, all of the usual suspects. I had 30 years of historical monthly returns. And when I plugged them into an optimizer, this is what I got. It's called a composition map. So at the bottom of the curve, what you have is way to the left is the bottom of the efficient frontier. Way to the right is the top of the efficient frontier. The composition of the frontier is mostly money market at the bottom, intermediate fixed in the middle, a long-term fixed near the top, and then the green is small cap value for this 30-year period. Obviously not a very well-diversified portfolio. So what we did was to invent something called the Michaud efficient frontier. It's a frontier that uses Monte Carlo simulation to have to try to capture all of the many ways things can happen that it consists of what you think you know, and then you have tail risk, black swans, all kinds of things that get included in such an efficient frontier. And it's a much better frontier. It's a much better diversified, efficient frontier. And if you don't believe that it actually works better, the world's authority said that Michaud beats Markowitz. The final leg of our technology is rebalancing. And we just talk very briefly about it. It's a very sophisticated technology. But every point on the Michaud frontier is an average of properly associated simulated Markowitz optimized portfolio. So every point is an average of portfolios, as you can see in the black area there. And then the green one is the portfolio that you own currently. The question is that green portfolio statistically similar or different from the portfolio you currently own, you currently think is optimal? And if it's very similar, you don't want to trade. Say we'd be trading in noise. And if it's not similar, then we should want to consider trading, and because that's probably when it is effective. It's not calendar-based, it's not asset-based, it's portfolio-based. It's, I think, the right answer. And it makes a big difference in our process. So globally diversified tax-efficient funds, 6 strategic levels, unique technology for short and long-term optimal. At this point, I'm happy to pass the baton over here to Vitaly, who'll talk more about performance.
Thank you, Dick, for an overview of our investment process. Now I'm going to take it away from you with an overview of global markets performance, asset class performance, and an overview of New Frontier portfolio performance for both quarter and the year. First of all, let's take a look at the global markets performance. A couple of highlights here. Emerging markets have been the best performer of the year. They have posted absolutely exceptional returns. Another important thing is Japan has done exceptionally well this quarter. Historically, Japanese market has been stagnant, but with loosening monetary policy, it has done slightly better this quarter, much better than in previous quarters. We'll see if this is a foreshadowing of the things to come, or it will revert to the mean. Once again, as Dick has previously mentioned, we do not forecast the future. Now let's take a look at asset class performance in a more granular fashion. Let's start with positives, and thankfully there were many of them in this bull equity market. China had a truly outstanding year, returning more than 50% for the year and roughly 6-7% for the quarter. And so did other international equities. It is important to note that much of this performance has been partially fueled by a flagging dollar. As you can see, the very last 2 bars show quarterly and yearly performance of US dollar. And for both year and the quarter, dollar has been negative, sometimes significantly so. Dick is going to talk more about dollar later in his macroeconomic overview. On the fixed income side, duration has done relatively well compared to other bonds. I will discuss this in a greater detail in a second. Finally, U.S. equities were positive for both quarter and the year. It's fairly impressive, especially considering how dollar has done. One exception to this is REITs, and it's important to keep REITs in mind going forward, especially considering the potential impact of the new tax law on their performance in the future. Now let's take a look at the interest rates and credit quality and how that has impacted different ETFs over the last quarter and year. Here on a graph, you have 6 different lines. 5 of them are ETFs, and the 6th one is dollar. So in green, you have returns of dollar over the last year versus a basket of currencies, and dark red are long corporates, teal are long treasuries, in light blue are high yield bonds, in purple are international treasuries, and in orange are emerging market bonds. First of all, international treasuries performance is an inverse of that of a dollar. That indicates that gains are mostly currency driven. Another point to notice is that fixed income securities of high credit quality have done well. Conversely, high yield underperformed. One explanation for this is linked to rising interest rates. As interest rates rise, borrowing costs for firms rise as well. Refinancing becomes more expensive and sometimes not even possible, and interest expenses in short term increase as well. This disproportionately affects lower credit quality firms, and therefore it is one possible explanation for why high yield bonds have not done as well as high credit quality fixed income securities. So what should we take away from all of this? Diversification remains important. It's important to invest in a disciplined manner, account for multiple possible scenarios of how future can unfold. And this is what we are trying to achieve here with our investment process. Now let's take a look at how our portfolios have done. On the graph, you see 4 bars. On the left, in teal and bright purple, are quarterly and yearly performance of New Frontier portfolios, and in blue and black on the right are quarterly and yearly benchmark performance. As you can see here, New Frontier portfolios either outperformed or closely matched benchmark performance for both quarter and a year for 2017 for our standard portfolios. The story remains the same for both our tax-sensitive portfolios and our multi-asset income portfolios. With this, I'm going to pass it back to Dick for his overview of macroeconomic conditions.
Thank you, Vitaly. Pretty interesting stuff to think about what did happen this year. It was a very interesting year. So I'm going to talk a little bit about my commentary, some selected topics, of course. Good year for equity investors, as Vitaly just finished telling us, but very low volatility, the Fed winding down, the new tax law, the global economic consensus, domestic policy, hedge funds, fixed income, geopolitical risk, and we'll bring a little bit of research here and something about the new index. Okay, a good year for equity investments, but an amazing lack of volatility. It's amazing. The S&P rose 20%. No day did it rise or fall by 2%, and only 8 days did it move by 1%. How do we think about all of this? It was true not only for the U.S. index, it was true for pretty much all of them. And the only possible explanation is the synchronized central bank monetary stimulus programs, a continuous flow of massive bond purchases here up until recently here in the U.S., and of course continuing in Europe and in Japan. And of course, China has a very highly managed economy that controls predictable low interest rates and currencies as well. Never has it ever been applied in such globally massive ways before, not the synchronized programs. It's a stunning validation of Keynes-Samuelson basic theory. However, you don't get in life, you don't get everything. You have to pay for what you get, and there's been trillions of dollars in balance sheet debt that has to be sold off very carefully. Okay. Another factor that some people may have not paid attention to is ETF investing. As ETFs grow in popularity, it becomes more important part in the stock market. Now, an index is roughly half the standard deviation of the stocks in it. An ETF is an index. So you have a lot of stocks in the market now that are actually index stocks. That might have something to do with the lack of volatility. Hedge fund volatility strategies are also something of a wild card here. There was an ETF that shorted the VIX and then returned 170% in 2017. I'm sure everybody managed to find that one for their clients. But volatility is keying off of the various kinds of things like low rates, debt expansion, asset volatility and trading. It's a strange mix of things here. Some people are worried that this might be the new portfolio insurance. There's a fair amount of concern about that. So we know, of course, that the Fed is winding down the 8-year monetary stimulus policies, 3 short-term rates increases this year, 3 to 4 forecasted next year, the slow sell-off. And then we have the tax cut law, which is just the opposite. It's a monetary stimulus policy, and I should say macroeconomic stimulus policy in reverse from the monetary policy. We are now, up until recently, fiscal policy was not possible, but with the new elections, fiscal policy is in reverse. Enacted, by the way, without a single bipartisan vote. Not necessarily a good idea. But the new tax cut law is not a terribly bad one, for sure. It is touted as the greatest business-friendly tax cut ever. And I think that might be a little bit of an exaggeration, but it is a business-friendly tax cut. And corporate rate used to be 35%. It's now dropped to 21%. But people should remember that the effective rate was about 26%. So there will be jumps in earnings, presumably, and some, I'm sure, will be dramatic, but others we'll see. There needs to be a sorting out of winners and losers. Might be a bit of bumpy markets as a consequence of this. The REITs are likely to benefit, but home ownership, the tax deduction cap, may not. The long-term tax cut issues, the corporate legislation is meant to be permanent, but for the middle class, there's limitations here. All of the tax cuts will be scaled back to current levels over time. And it's kind of amusing to think that, except for the first year, tax increases will then occur every year for the next 9 years, unless they change the law. It's not a very. That's kind of a funny thing that everybody's going to get a tax increase for the next 9 years after this. Now, hedge funds, and there's been the lack of volatility has been unkind for many hedge funds. One of the things that's been happening in 2017, and many people will continue in 2018, and has been continuing for quite some time, is an increasing number of hedge funds have been terminated. It's interesting that this is part of what's going on here because of the low volatility. Cryptocurrencies, it's awfully hard not to have a conversation with anybody in finance without talking about cryptocurrencies. The technology is very interesting. I find it very interesting, but it will take time to properly value. The start of future trading has got to be very, very helpful. Gold is a conceptual competitor because it's basically a universal numeraire that we're talking about with cryptocurrencies. It clearly is not an asset that belongs in long-term investing, at least not right now, that's for sure. In the meantime, please don't lose your password. You might lose a lot of money. So to look ahead, a general economic consensus exists that the U.S. economy is in robust health. There's really a wide consensus. The new tax law is friendly, should provide stimulus for growth, but the Fed is tapping on the brakes, and the new tax law is putting fuel to the economic engine. So the two are going in opposite directions here, and there's a little bit of a concern about that. Given the other reason for being concerned is that currently we're in robust GDP growth, and essentially what a lot of economists think, full employment. So the net effect of adding fuel to the economy over time may, in fact, create something of a sugar high and limit U.S. competitiveness relative to other economies that are not inconsistent monetary and macroeconomic policy. And I note that there's been 11% decline of the dollar during this time period. So while the market went up 20%, the end result is roughly 7% growth in equity indices this year on a purchasing power basis. Fixed income investing is extremely complicated. The current economic policy is not a friend to the bond market. Tax cuts favor equities, flattening yield curve, Fed trimming, tighter monetary policy ahead. We will be very much bird-dogging the bonds in our portfolios. And I just don't have any particular way of saying anything more than to say that we will be paying a lot of attention to everything we can get our hands on. And geopolitical risks are at great height, in spite of the fact that we have business channels and so on. Much of what they talk about are all of the geopolitical risks. And the Trump administration has reversed a long list of principles and policies going back to the Revolutionary War. And the North Korean issue is very serious across the entire world. The Russian Mueller investigation is a very serious wild card for the American economy. And we have, of course, an American first policy that has to do with immigration, military, economic, and trade policies. Who knows where all of this is going, but it certainly has been extremely disruptive in both domestically and globally. Against a backdrop of great political uncertainty, markets remain preternaturally calm. I have no idea how to explain that. So we will go from there to maybe something more kind of interesting. New frontier strategies are efficient frontier portfolio based, as I showed you, the efficient frontier, the Michaud efficient frontier. And what we have noticed is that traditional value ETFs tend to populate the lowest part of the frontier, and more growth-oriented ETFs tend to populate the upper frontier. So in some sense, we are both value and growth managers, or neither value and growth managers, depending how you want to see all of this. But there's more to it, the story, than just value and growth, because usually that's so important, that dichotomy. But there's smart beta factors as well. That's very much something that's part of the discussions for many, many people, again, on the business channels and other things. We have smart beta factors. Small cap emerging ETFs, for example, tend to be in the upper part of our frontier. And involve real estate, fixed income tend to be in the lower part of our frontier. We have no need for the concept of smart beta investing because we are smart beta investors. The problem with smart beta investing, as everybody should know, I hope everybody knows, is that they are highly time period sensitive, highly time period episodic. The benefit of having a holistic frontier management framework is that we don't have to worry so much about the episodic character because they're all included in the how we manage the entire efficient frontier. And as global capital markets evolve, what we will see as well is that the smart beta factors and the value and the growth factors will evolve in different ways within the context of the efficient frontier. So the Michaud frontier, just like the Markowitz frontier theoretically, is actually a universal institutional framework for asset management and practice. I think it's a concept that we've lost sight of because we too often think about individual securities. We too often think about individual fine-tuned strategies, but the frontier, a working Markowitz frontier, is, I think, a universal institutional framework for asset management and practice. It's the way to think about investing. It really is, I think, foundationally correct. So one final topic from me. I wanted to tell you that we just launched in December, the beginning of December, what we call the New Frontier Global Balanced Index, NFGBI. It's on Bloomberg, it's on other places. It's a truly unique benchmark, and that is unique from many perspectives. Now, we can't just talk about all of them, but it's an institutionally managed index. The S&P is an institutionally managed active index. Many people don't realize it, but the investment committee, the S&P, manages that index, just like we manage our ETFs. So we are, in some sense, an institutionally managed S&P index for global investors. A number of people might find that a particularly appealing way to think about what we are doing at the global level. We are risk-targeted 60-40. That is a benchmark that is very much the institutional benchmark of choice for large financial intermediaries, pension plans, and so on. It is also the way many long-term advisors think about long-term investing. It is an active strategy, and it's an active index, and of course, multi-asset ETFs. So there's no index even close to being like this index anywhere in the world today. It is also a showcase for NFA's investment technologies. People long-term used to say, well, if you guys are so smart, why aren't you managing money? So we have been managing money now for 13 years. And what you see here at Bloomberg and all of that, and you can see our our performance on a model performance basis for the last 13 years. It's not a back test; it's our actual model performance. So all of these ideas in this are in our book. And let me turn it now to marketing, Margaret.
Sure. Thank you so much, Dick. So we will now be opening the floor up for any questions from the audience. As a reminder, your lines are muted, so please submit any questions using the chat feature of GoToWebinar. I think we can start off with just a quick question about process, reaching back a little bit, but just a question about rebalancing and specifically how we're looking at rebalancing, and do we look at ranges around specific asset weights?
Well, thank you so much for that. Good question. That's perfectly, you're setting me up perfectly. Thank you for that. No, it's portfolio-based. Everything we do is portfolio-based. So let me try to explain again what's going on in the schematic on the right-hand side. Every portfolio on the Michaud Efficient Frontier is an average of properly associated, simulated Markowitz optimal portfolios. So if we do 10,000 simulations, we have 10,000 possible Markowitz optimal portfolios that are associated with that one kind of orangey or brown point, and we take all of them and average them, and that's the brown point. So now we can then look at those points surrounding the optimized portfolio and saying, hey, that's a normal distance away from that point. And then we can plot the current portfolio, the green portfolio, and we ask the question, is that green portfolio statistically similar to the brown point or not? And if it's close enough, we can say we don't need to trade. And if it's far enough, we say, well, gee, it really does need to be thinking about trading. So it's not calendar-based, and it's not asset-based. It's portfolio-based. That green point is a portfolio, and the brown point is the currently optimized portfolio. And the black points just tell us, in some sense, how far away the green point is within a football surrounding the brown portfolio.
Great, thank you, Dick. All right, so I guess skipping forward a little bit, so you had mentioned that New Frontier has value assets and conservative portfolios and growth assets and aggressive portfolios. Could you elaborate a little more on what that looks like?
Yeah, sure. Oh, where do I want to go with this? I guess I would like to go here. Yeah, I'm getting close. That's it. Thank you. I know I get there eventually. It's a good thing that I have good friends over here helping me here. But what's going on is that the 20% equity portfolio, the bottom point on the Efficient Frontier, right, is very much, I mean, even if we didn't make it 20 and 80 portfolios, it would have mostly fixed income securities, real estate, minimum vol portfolios, and it would have ETFs that tend to be more value oriented than if you go towards the top. As you go up the top, you get more risky assets that have more variance, more standard deviation, more volatility, and down at the bottom, less variance, more like value securities. So it's interesting that you can think of almost any smart beta strategy, and in some sense, it's part of this overall framework. And what Harry Markowitz wanted to do back in 1952 was nothing more and nothing less than to provide us with a universal framework for asset management in practice. And what we have done is to just implement it so that it's useful in practice. The Marquis frontier does not really work in practice, but theoretically it was a universal framework for asset management. And all of the strategies that people talk about, it's really here. It's here somewhere. And as the global economy evolves, how they fit will be changing over time, and then depending on different kinds of risk characteristics of what's going on in the economies in the world.
Great, thank you. So then just to wrap up, we just have a couple of quick updates from marketing. As always, we do encourage everyone to take a look at Frontier Advisor. That is our one-stop resource center for advisors. It's a great resource for looking up marketing materials or portfolio analytics. That's all available to you at frontieradvisor.com. So please do take advantage of that. Dick mentioned that we have just launched our New Frontier Global Balanced Index, and you can read a little bit more about it on our website and also view the index on Solactive. So we encourage all of you to take advantage of the availability of the NFGBI. And finally, what Dick did not mention is that he will be teaching a 5-week course for the CFA, which is Finance's Wrong Turn, a revisionist view of modern finance in practice. So I know Dick is very excited to be teaching this course, and you can learn more about it and register for the course at CFA Boston's website. So that is all we have for you today. Thank you so much for joining us, and have a great rest of your day.